Welcome back, bag chasers. You are locked in with the bag breakdown. Today, we are doing something a little different. We're not just breaking down one stock. Oh no, we are doing a full-on CAT scan of the entire market's brain. We're using the receipts from Seeking Alpha dated January 13th, 2026 to put this market on the operating table, slice it open, and see exactly what it's thinking. What is it afraid of? And most importantly, where is it quietly placing its bets for the next big move? Forget the talking heads you see on TV, forget all the noise you see on social media. We are going straight to the source, looking at the raw data to build our own thesis from the ground up. Look, so many people out there are just guessing, right? They're making moves based on a feeling, a gut check, or what some so-called guru told them. That is not how we do things here. Here, we look at the receipts, we analyze the data, and we build a strategy based on cold, hard evidence. We're about to figure out what the market is really cooking up today. Beyond all the noise, beyond all the drama, this is all about understanding the crosscurrents, those hidden narratives, and the subtle shifts in sentiment that tell you where the big institutional money is about to flow. So let's get into it.
Okay, first up, let's look at what's on the front page. This is the stuff that everybody and their mother is talking about, the main plays in the trending analysis section. You can think of this as the surface level, It's the popular kids' table in the cafeteria. This is the battlefield where the big, obvious narratives are duking it out for your attention, and more importantly, your capital. Understanding what's happening right here is step one, because it tells us what the majority of the market is thinking.
All right, receipt number one, look right here, Broadcom. The headline is Pure Uncut Hopium. It says, buy the dip or regret it forever. Now, that's not just an opinion, that is a command. This right here is the dominant story in big tech right now. It tells us that even with all the wobbles, the market's muscle memory is to immediately, almost blindly, buy any weakness in a blue-chip AI-adjacent tech name. The big funds, the retail crowd, everybody, they still have this massive, almost insatiable appetite for these giants. The core belief is just that these companies are fundamentally untouchable in the long term, so any price drop isn't a problem, it's a gift-wrapped opportunity. But hold up a second. Look at this. Right next to that Broadcom hype piece, you have got this major warning shot fired at Micron. The headline reads, "The memory chip cycle is turning against you." Now, this is crucial. This shows a major crack in that whole all tech is good tech story. So while one part of the semiconductor world is getting a buy or regret it forever stamp, another corner is getting a skull and crossbones. The market is being extremely picky. It's basically saying, yeah, we love the high margins, specialized AI chips from companies like Broadcom, but we're getting really, really nervous about the commodity memory chips from a company like Micron. Go ahead and pause the video and read that headline again. It is a perfect example of the market's split personality right now. Then you've got this third angle on big tech, and it's a totally different flavor. Meta platforms. Look at how they're framing this. Beaten down AI player. This is not a buy the dip narrative like we saw with Broadcom, and it is definitely not a warning like Micron. No, this is a classic value play narrative emerging in a mega cap stock. The argument here is that the market has punished Meta way too much, that the stock has overcorrected, and now it's a bargain, especially with its AI potential. This tells us the market is actively hunting for discounts, even among the biggest companies on the planet. They're sifting through the giants, trying to find the one that has been unfairly left behind in the rally.
Wait, hold on a sec. Dividend growth? What does that even mean for us? That sounds like something my grandpa talks about.
That's a good question, and trust me, it's not just for grandpas anymore. Let me break this down for all the bag chasers out there, because this is a super important clue about the market's real mood right now. It shows that beneath the surface of all this high-flying tech talk, there's a whole other, much more cautious game being played. So, look, anybody can find a stock that pays a dividend. That's just a small piece of the profits paid out to you in cash. But dividend growth investing is a totally different animal. You're specifically looking for companies that are so solid, so financially sound, with such a strong moat that they can afford to give their shareholders a raise. Year after year after year. It's not just about getting paid now, it's about getting a pay raise every single year just for holding the stock. The fact that this is trending is a huge signal. It tells us that a big chunk of investors are getting defensive. They're getting tired of the crazy swings, and they're looking for stable, predictable, growing cash flow. It's a quiet flight to safety and quality happening right next to all the frantic buying of tech tips.
All right, so that's the mainstream noise. Broadcom, Meta, dividends, that's what everyone sees on the front page. But we're not here for that, are we? We are here for the side pockets, the undercovered stock section. This is where the hedge funds and the deep dive professional investors are quietly placing their bets away from the spotlight. This is where you might find the real alpha, the ideas that haven't been picked over 1,000 times already. So let's get these receipts and see what the smart money is trying to hide from the crowd. First step, we've got Alpha Tech Holdings. It's a medical hardware company. Look at this. It's super niche. Most people have never even heard of it. The headline says backing improves, which is just Wall Street talk for analysts are getting more bullish. They're upgrading their ratings, raising their price targets. This isn't a bet on the Fed or inflation or some broad AI theme. This is a bet on a very specific technology, a specific product in the spinal surgery field. It's a powerful reminder that there's a whole universe of stocks out there that trade completely independently of the big tech drama. Finding a winner here is about deep, fundamental research on one company's patents and sales, not about guessing where the Nasdaq is going next. Yo, show us the receipts on that. The headline says holding NAV. What's NAV? Break that down. Bet. NAV, or net asset value, is basically the true fundamental price of one share of a fund. Think of it like its liquidation value. If they sold every single stock and bond inside that fund and paid off all their debts, the NAV is what would be left over per share. So when this headline says NVDY is holding NAV while paying high yields, it's making a really powerful claim. It's saying this fund is paying you a fat check, a high yield, without its fundamental price collapsing to pay for it. It's not eating itself alive just to pay you. A lot of high-yield funds, they see their NAV just decay over time, which means they're pretty much just giving you your own money back. This one isn't. And that is a powerful combo, high income and principal stability, that the market is clearly desperate for right now. Then you see this, a deep dive on Boeing. Now this is a pure contrarian play. The headline itself is skeptical. The sky is still clouded. This isn't some hype piece. It's a sober, serious analysis of a fallen angel. I mean, Boeing has been through the absolute ringer with safety issues, production delays, management shakeups, you name it. A bet on Boeing today isn't a bet on some hot trend. It is a high-risk, high-reward bet that this massive critical industrial giant can finally get its act together and stage a historic comeback. Investors are literally digging through the wreckage here, looking for a potential multi-bagger recovery play, but they're doing it with their eyes wide open to all the risks involved. So when you zoom out from these individual names, you see a really clear pattern forming in these side pockets. I've broken it down for you right here. You've got these contrarian bets on high yield, like Blue Owl and NVDY, which we just talked about. You've got super niche tech and medical plays like Alpha Tech that really don't care what the broader market is doing. You have massive industrial recovery stories like Boeing. And then you also see bullish cases for energy stocks like Antero Resources, and this hunt for a high-quality investment-grade yield from things like preferred stocks. This is the smart money at work. It's not just buying the S&P 500 index. It's making very specific, surgical bets on uncorrelated themes that can win no matter what the rest of the market does. Okay, so we've seen the individual plays, both the mainstream ones and the niche side pockets. Now let's zoom out one more level and check the macro vibe. We have to read the room. A stock doesn't exist in a vacuum, right? It exists in the wider economy. And the economic room right now is sending some seriously mixed signals that are making everybody pretty nervous. Just look at this. On the left, you can see the big picture for stocks. The S&P 500 is in the red. The Nasdaq is in the red. The Dow is in the red. It is a sea of red right across the board. That signals fear. It signals a risk-off mood where investors are selling first and asking questions later. But then look over at the chart on the right. Crude oil is spiking, up over 2.6%. Now, these are sending two completely opposite signals. Normally, if the market fears a recession and sells stocks, oil prices should fall because economic demand is expected to drop. But here, stocks are down and oil is up. That's a major conflict, and it points to a very specific fear. And here's the kicker that makes it even weirder. The news just came out that U.S. crude stockpiles rose by 5.3 million barrels last week. That's a huge number, a big build in supply. Basic economics tells you if supply goes up, the price should go down. But the price is ripping higher anyway. This tells us the market is completely ignoring the current supply levels and is worried about something else entirely. Maybe it's geopolitical conflict, maybe it's future supply chain issues, or maybe they just believe global demand is going to be way stronger than expected. Whatever the reason is, rising energy prices while stocks are falling screams one thing: stagflation. And that could mean inflation is staying sticky, which makes the Fed's job a whole lot harder and complicates everything for us investors. So, we've looked at all the receipts. We've seen the main plays with their conflicting messages on tech. We've dug deep into the side pockets where the smart money is making those surgical bets on yields and recovery.
And we've checked the macro vibe, which is giving us a massive headache with its contradictory signals on growth and inflation. So what's the final verdict? What is the move here? Do we secure the bag, or is it time to drop it?
Okay, let's lay the full argument out on the table. Bull versus bear. The bull case is strong. There is still a ton of appetite to buy the dip in big tech, that's clear. We see that smart money isn't just sitting on the sidelines in cash, it's actively seeking alpha in these niche side pockets and value plays. But the bear case is just as compelling, maybe even more so. The major indices are flashing red across the board. Rising oil is a massive red flag for inflation and the broader economy. And even within the market's favorite sector, tech, there are serious conflicting signals between hype and fear. The fact that defensive dividend plays are trending is another huge point for the bears, showing a clear underlying move towards safety.
So the crucial point is this, and I really want you to let this sink in. The market does not have one clear mind right now. It's completely fragmented. It's schizophrenic. It is simultaneously playing offense and defense. It wants the perceived safety of a blue-chip stock like Broadcom and the reliable cash flow of a dividend grower, but at the exact same time, it's making these high-risk, speculative bets on a Boeing turnaround and some obscure medical tech. It's a market that cannot make up its mind, and that indecision creates a very dangerous and volatile environment for all of us.
My final verdict from all these receipts is this: secure the bag, but do it cautiously. The big takeaway from today's market X-ray is that this is absolutely not a time to blindly buy the index. The S&P 500 is just a mess of conflicting signals. This is a stock picker's market, period. The real alpha, the real opportunity to outperform, is not in the main plays that everyone is screaming about. It's in the side pockets. It's in finding those uncorrelated, niche stories that we just uncovered today. Find your niche, do your own research on these specific themes, and stay incredibly sharp. That is how you secure the bag in a market that's confused. That's our breakdown. Drop a comment below with a stock you're watching. I want to see what side pockets you all are digging in. See you next time, bag chasers.